So last week we discussed two chapters. They were pretty complicated, so I want to go over the material again. Obviously, if you've already done the homework, great. If not, this might help you. And also, this might be a little something you might want to view as a review for the final exam, just so that you can perhaps make all the concepts a little clearer. So Chapter 18 was really all about definitions: exports, imports, net exports, trade balance, trade surplus, balanced trade. And the important thing is to recognize that when we measure exports and imports, we're going to convert everything into dollars so that we can compare the value. So exports which are the goods that are produced in the United States that are sold abroad. We're going to value those in dollars. Imports are also which are the goods that are produced overseas that are consumed here in the United States. We're going to value those in dollars, and so then the trade balance will be, or net exports will be the value of exports minus the value of imports. And if that's a negative number, we call that a trade deficit. And if it's a positive number, we call that a trade surplus. And we use the abbreviation NX to stand for net exports. So that's on the goods and services side. There's also the financial side, and so we're going to take a second here and discuss that a little bit. So remember when we were talking about the closed economy, we came up with a identity really that investment equals savings. And we set that up, we defined savings as the amount of production in the economy minus consumption, minus the government purchases of goods and services. And in a closed economy, this would just equal I, which is investment. And since consumption minus government spending, production minus consumption minus government spending equals savings, savings would equal investment. But now we're going to add in net exports. Because remember, y equals c plus g plus I plus nx. So if we subtract c and g from y to get savings, so we then come down to this idea that savings equals investment plus net exports. Now, there's this other concept which we're going to call net capital outflow. And we're going to abbreviate that NCO. So now we're going to define a new concept that we're going to call net capital outflow. Which we're going to abbreviate NCO. And net capital outflow is defined as the purchase of foreign assets by domestic purchasers, which could be residents, could be companies, minus the purchase of domestic assets by foreigners. Now, we're basically going to think about two kinds of purchases that can be made. One is direct foreign investment. So that would be when a domestic company or a person builds a factory in another country. That would be a direct investment. It could also be a portfolio investment. So when a U.S. person or a company buys stock in a foreign company, or bonds from a foreign government, or bonds of a foreign company, that would be a portfolio investment. But either way, we should think about how the real interest rate would affect both of these. Notice a higher real interest rate here in the United States would make purchasing U.S. assets more desirable, and so it would probably reduce the amount of foreign assets that the U.S. folks would want to purchase, because they might want to just keep the money here and get a nice return. And similarly, a higher interest rate here in the U.S. would probably increase the amount that foreigners would want to purchase of U.S. assets. So in terms of a higher interest rate, it would tend to reduce this number and tend to increase this number. And so a higher interest rate is going to lead to a reduction in net capital outflow, and a lower interest rate here in the U.S., or vice versa, would obviously lead to a higher net capital outflow. So net capital outflow is a function of a number of things, but very importantly is a function of the real interest rate. All right, so and then one of the other things that we really need to recognize is, and you just have to sort of take this on faith, but if you really think about it, you'll understand that it's true, that net exports is going to equal net capital outflow. And the reason for this is that if I, say, purchase a Japanese car, then the Japanese company has the US dollars, and there's basically only two things they can do with those US dollars. One, they could purchase US goods and services, in which case then net exports would go to zero because I've bought a Japanese car and they've bought US goods and services and there is no net exports. Or they might buy a good, buy an asset here in the United States. Buy bonds, buy stocks, invest in a factory here in the United States. And so either way, that money has to come back to the U.S., and if it comes back in terms of net exports, then that's going to reduce net exports, and if it comes into the form of purchase of an asset, it's going to reduce net capital outflow. So right now, net exports is a negative number in the United States, and net capital outflow is also a negative number, meaning that we're selling more goods, so we're buying more goods and services from abroad than we're receiving, than they were purchasing, and that means that more foreigners are buying U.S. assets than we're purchasing assets abroad. Okay, so that's the definition or part of the net exports and net capital outflow part. The next concept that we're going to have to talk about is exchange rates. So an exchange rate is the amount of one currency that you can purchase for another. So how many yen you can get for a dollar, how many euros can you get for a Mexican peso. The foreign exchange market is actually the largest financial market in the world by a lot. All of the stock markets, all of the bond markets combined are going to be significantly smaller than the foreign exchange market. Currencies are being traded every moment of every day all over the world. Everything from you just take a trip to Europe and you get off the plane, and in the airport you change your dollars into euros, to multinational corporations that are trading goods and services across national boundaries that are making huge transactions in different currencies, to, of course, investors who are just speculating on where one currency is going to move compared to another, and who are making, in effect, large bets on the direction of one particular currency versus another. So an exchange rate is just the number of amount of one currency that you can get for another. And if we think about, say, the U.S. dollar might be worth, so $1 might be worth, say, 140 yen. And if the yen depreciates, so that $1 then becomes equal to 150 yen, we say that the dollar has appreciated, it means it's gone up in value compared to the yen, and that the yen has depreciated, meaning gone down in value compared to the dollar. We also are going to be talking about real exchange rates, and I'll have an example about that. But a real exchange rate, just like when we use the word real in this course, we basically mean we're taking out inflation. So a real exchange rate is basically the purchasing power of one currency in terms of another, which means we want to take out the effect of a change in prices. Generic equation up on the board. So the real exchange rate equals the nominal exchange rate. I'm going to use FX for exchange rate. The nominal exchange rate over the domestic price level, and we'll use P for the domestic price level, divided by P star, and P star we're going to mean the foreign price level. So the real exchange rate is the nominal exchange rate times the domestic price level divided by the foreign price level. And let me use an example to discuss this. So suppose the Mexican peso depreciates against the U.S. dollar from 10 pesos to 15 pesos. So at one point, $1 equals 10 pesos. And some later point in time, if you say a couple years later, $1 equals 15 pesos. So we would say nominally that the dollar has appreciated and the peso has depreciated. But suppose at the same time, the price of everything in Mexico measured in pesos rose by 50%. So that means that the Mexican price index, say it rose from 100 to 150. So let's say during that same period of time, price index in Mexico $100 to 150. And let's just assume, for the sake of discussion, that during that same period of time there was no change in U.S. prices. That's actually not as unrealistic as it sounds. In the past year, U.S. prices have risen only 0.9%, less than a full percentage point. So prices in the U.S., at least overall, have been pretty flat in recent years. So now let's think about what things were. Remember my definition of the real exchange rate. So let's figure out the real exchange rate before all these changes. So the real exchange rate is going to be the exchange rate, which was 10, times the U.S. prices, which we'll just say was 100. We'll say we're at the base year, and the Mexican price level, which was also 100. So the hundreds are going to cancel out, and the real exchange rate was 10. And now let's say we're moved into our future period, and let's say the real exchange rate is going to equal 15, because that's the exchange rate. The U.S. price level is still 100, but now the Mexican price level has also risen 150%, so we're now at 150. The Mexican price level has risen 50%, so we're now at 150, and so you can do the arithmetic, and you'll see that the real exchange rate has not changed at all. So let's say that a hotel room initially cost 1,000 pesos. That would have been $100 a night. So a traveler who wanted back in this, when it was 10 pesos to the dollar, traveler from the United States who wanted to go stay in Mexico, and the cost of a hotel room was 1,000 pesos a night, it would cost them $100. After the price rise and the depreciation of the peso, if the hotel room now costs $1,500 a night, 1,500 pesos a night, it would still only cost the traveler $100, because that $100 would buy the 1,500 pesos necessary to pay for that hotel room. So there would be no reason for the U.S. tourist to change his plans just because the price of the Mexican hotel room went up by 50%, because the value of his dollar also went up by 50%.